My host, please, can you confirm that you can hear me and you can see my screen? My host, can you confirm that you can hear me clearly and you can see my screen?
Yes, sir. I can hear you and I can see your screen, sir. Good evening, sir.
Good evening. All right, so good evening, class, and welcome to our taxation class this evening. This is the second session of our class, and we shall be taking some topic called taxation of investment income. Now, this is a topic that also comes out in the examination, investment income. At the end of this topic, we shall understand things like taxation of investment income, which includes unearned income such as dividends, interests, rent, and royalties. We shall look at the basis period of assessment for investment income and what are those investment income that are exempt from tax. We'll look at the allowable and disallowable expenses connected with various investment income. So right away, let's go to investment income. You know, many businesses or taxpayers derive their income either by being in employment. For example, you go to work and you are paid salary, or you are in business, trading or rendering service, and you get paid. These are for individuals. Now, companies gain their income mainly by carrying out business activities. And this gives rise to things called employment income and trading income. Now, these income are earned when you are physically present. So if you don't go to work, you won't get paid. If you don't carry out marketing activities or you don't go out to conduct your trade, you will not get paid. And so they are rightly called earned income. Now, there are some kind of incomes that you don't have to be physically present for you to earn, and they are called investment incomes. Now, investment incomes are received primarily from investment decisions. Investment decisions include decisions such as you purchase shares of some company, you purchase properties for letting, for rental purpose, or you look at these examples I've given here. When you purchase shares, you are going to be paid dividends. When you purchase properties for let or for renting purposes and you rent them out, you are going to be getting rental income. And when you put your cash in a fixed deposit, you get interest. And so the incomes that accrue as a result of investment decisions are called investment income. And these are dividends, interest, rent, royalties. So these are things we shall concentrate our discussion tonight. Now, when I talk about investment, your mind should not wander to those investments you see on WhatsApp where they will tell you, please come and invest in 45 minutes or 1 hour, you get money back. No, that's not what we are looking at. We are looking at legit investment, dividends, interest, rent, and royalties. What is the basis period for investment income? It is the preceding year basis. And now, because it is in the preceding year basis, the new Finance Act 2019, 2020, and 2021 does not have too much bearing on them because the tax system today is based on preceding year basis. So it is alignment with the new Finance Act. Now let's look at some of the income that we are going to be considering. Dividend income. Dividend is the profit distributed by a company to its shareholders in proportion of their respective holdings. You go first to buy shares, like we all do. We used to buy shares from banks and some companies. If you buy 10% of the company's shares, when the company is giving out profits, which is dividends, you are going to get 10% of the profit. If you buy 1% share, you get 1% dividend. Now, some of us, we used to buy very few amounts of shares, and so when the dividend comes, it's almost meaningless because the percentage of which we are buying is almost meaningless. So like garbage in, garbage out. When you are buying dividend shares from a company, just know that the percentage of your holding will be the percentage of the profit that will be given out to you. Now, a Nigerian dividend is the income derived, the income from a dividend distributed by a Nigerian company is called a Nigerian dividend. Now, why is it called Nigerian dividend? This is because it is incorporated in Nigeria. So it means that if Nigeria, Globacom is Nigerian company, right? So Globacom distributes income to shareholders. It is deemed to be derived from Nigeria. But Globacom Nigeria is Nigeria. So why are they using the word deemed? This is because you may be dealing with an international company. Let's say we have Glo Nigeria, we have Glo Ghana, we have Glo South Africa. Now, because they are in different countries, that doesn't change the fact that they are Nigerian companies. Just as MTN Nigeria is Nigeria, but it doesn't change the fact that it's a South African company. So if Glo Ghana is giving out dividends, since Glo is a Nigerian company, it is deemed. So you see the word, they are deemed to be derived from Nigeria. And it shall be the gross amount of that dividend before the deduction of any tax which the company is required to deduct on payment thereof under the provision of the law. What it means here is this. If you earn 200,000 naira as a dividend, gross dividend. Notice the word here, gross is used. Is the total dividend accruable to you. The law says that a tax on dividend should be imposed, and that tax is called the withholding tax. It is applied at the rate of 10%. So you are earning 200,000, and the law says take 10% out of 200,000. That is 20,000. It means you are going to be paid 18,000. Now, because you received 18,000 in your bank, that 18,000 is not the gross. So you just have it in the back of your mind that when you get a dividend received in your bank, it is the net. But when you are reporting it, you should report the gross. That is what it is saying. So you received 180,000. How do you report the gross? You know, 80,000 means that 10%, 180,000 rather, means 10% has been taken away. That 180 represents 90% of the gross. So you simply divide that 180 by 0.9 and you get the gross. Let's do it together. I believe you can all see my calculator now. You have 180,000, which is your gross, your net rather. If you divide it by 0.9, representing 90%, you get your gross of 200. All right. Now, that is how you convert from net to gross. If you are giving gross and you want to convert to net, you simply multiply 200,000 by 0.9. That gives you the net. So that's how you convert. So because you are told by the law that if you are paid this net, the law wants to see it converted to gross on your book. So that's it. Now, territory in which dividend by a Nigerian company arises. Where a dividend is distributed or paid by a Nigerian company, the dividend, whenever necessary, shall be deemed to be derived from the territory in which the recipient of the dividend resides, or where the recipient is not resident in Nigeria, the person shall be deemed to be a person resident outside Nigeria and who derives income or profit in Nigeria. Dividends received by a non-resident person shall be deemed derived from the Federal Capital Territory. Now, what it means here is if you are earning dividends as your income, it means that the territory where you are going to declare your tax, that withholding tax that is being deducted from you, it shall be payable to the place where you are deemed to be resident. So there is a topic called residency. That topic will help you to understand how to resolve residency. So there's something called principal place of residence. So if you are principally residing somewhere, so because you don't have to be physically present for you to earn investment income, so it means that anywhere you reside in Nigeria, you can sit down, make your investment decision. And so your withholding tax is going to go to that place where you are deemed to be principally resident. If you are not a Nigerian resident, meaning you don't stay in Nigeria for at least 183 days, you are a non-resident. Take, for example, Nigerians in the diaspora, and you derive income in Nigeria and you're a non-resident, it is deemed to be derived from the Federal Capital Territory. And so your withholding tax will go to the Federal Capital Territory. Now, dividends exempted from tax. So there are some dividends that are exempted from tax. These are dividends earned from abroad and brought into Nigeria by a Nigerian resident in convertible currency and paid into a domiciliary account in the bank approved by the government. Now that way, you are being exempted from tax. Dividend distributed by unit trust, dividends received from small companies in the manufacturing sector in the first 5 years of the operation, dividends received from investment in wholly export business, and all the other things you have there. So in the exam, you might be asked to give out to write notes on dividend exempted from tax. So you have to remember that. Now let's talk about something called the franked investment income. I call it FII, franked investment income. Now, any dividend received by a company after the deduction of withholding tax at source by the paying company is regarded as franked investment income in the hands of the company receiving the dividends. Now, let me give you an example. Let's say FCA buys FCA shares. Now, it means that ABC have invested in FCA. Now, if FCA is paying dividends to ABC, let's say the gross dividends that ABC receives is 200,000. FCA will not pay the whole 200,000. Holding tax at source, meaning it's going to pay ABC 180,000. The 20,000 related to this, the first, that is a tax suffered by ABC for that investment. Now, ABC has received the dividends in net, but ABC will not record net. They will record it as gross. But although we all know, you and I know, they receive net. Now, this net that they receive, whether you are writing it as net or you are writing it as gross, is seen in the hands of ABC as a franked investment income. Now, when you have a franked investment income, it is not subjected to further tax. It means the withholding tax that you have previously suffered is going to be the only tax suffered. So it means that when you are trying to tax your business or your lines or source of income, you have to exclude franked investment income. You have to exclude it from the total profits before computing the income tax liability. The reason why we are excluding it is because it is not going to be subjected to further tax. Now, in a situation where the receiving company has collected dividends, which is called the frank investment income, and then it is redistributing it to its shareholders. Let me explain. Now, ABC has collected shares and dividends from the shares it bought from FCA. ABC has suffered withholding of 20,000. We all know that. Now, ABC is now redistributing these dividends that it has received. Okay, now it becomes that there are some people who bought shares of ABC. Let's say Mr. Chima, Mr. Femi, and Mr. Izu. We all buy shares from ABC. Now, ABC, having collected shares from FCA, is now distributing that dividends it got from FCA to these three people. That is what we call redistribution. It is different from ABC shares. ABC shares getting dividends, and we are now distributing. That is called distribution. It's different from redistribution. Redistribution means you collect from someone and you are now sharing that proceed you collected to other people. Now, law says that when you are redistributing to your own shareholders, the company has a right to withhold tax, withhold the tax from the redistributed dividends and use it to offset the withholding tax that they have suffered. It means that if ABC collects 180 from FCA, from FCA as dividend net, and it is redistributing the whole 180, or let's say it's 200 now, because you must record it at gross, and it is redistributing the whole 200. It's going to charge 20,000 naira as withholding tax from the people it's redistributing it to. But the law says that 20,000 you collected on redistribution, don't remit it to government. Take it to offset the 20,000 you suffered when you got your own dividend from FCA. Of course, you have to explain that redistribution. So it helps to prevent double taxation. It means that the FCA has remitted the same 20,000 and we are redistributing it, collect 20,000 again, and you will now give it to government. It means that one income would have suffered tax twice. So it means government would have collected 40,000 on just say one income. So it means that no, you are going to use it to recover what you have suffered. So it's just that it's only you who is the original shareholder of FCA that have the ABC, who is the original shareholder, would have suffered what is being remitted to government. So government gets remittance just once and not twice. And so that prevents double taxation. Now let's see an example of how this is applied in real life. This is example 1. This is called Tata Limited. Now look at this. In the year 2000, Tata Limited received a net dividend of 180,000 after the deduction of 10% withholding tax. Now this, just like the example we are just giving to you. Now, we all know that this 180,000 net is a gross of 200,000, right? Now, during the accounting year ended 31st December 2000, it made a total assessable profit of 2,850,000, including the gross dividend received. Now, what it means here is income from all sources gives you an assessable profit of 2,850,000, including the 200 that you receive as dividend gross. In the same year, the company paid a gross dividend of 700,000 to its shareholders, including 140,000 of the dividend received gross. What it tells here is out of the 700,000 that was paid out as dividends, 140 of them came from the 200 that they received. So they received 200 and they are redistributing 140. So it means that 700 minus 140, which is 560,000, is fresh dividend distribution, while 140 is redistribution. So what we are told here is the dividend of 140 you are redistributing, the tax you are going to collect, use it to offset part of the 200,000 that you receive as dividend, which is suffered withholding tax. Required, compute the income tax payable on the company's profits. Second one, compute the withholding tax due from the company. Now, let's get down to business and look at the solution. This is the solution now. The first one here, computation of income tax payable on company's profits. In what year? In year 2001 tax year. This is important because I said the tax is charged on preceding year basis. So you are given year 2000, your tax year is 2001. Now, assessable profits, including gross profits, we are told it was 2,850,000. So it means the gross income is inside there, of the gross dividend is inside there. So it's as good as saying income from all sources. Now, we are told that dividend income received from a Nigerian company is seen as franked investment income, and it should be excluded when you want to look for the tax liability. Now we are told to compute income tax payable. So now let's exclude the gross dividend that we have received. So the frank investment income is simply the gross dividend. Now this is 180, and by saying 100 divided by 90, you are also doing 180 divided by 0.9. It's the same thing, and you have your 200. It means that 200 out of this 2,850,000 should not be subjected to further tax. So when you deduct it, that means the taxable profit, this is where you are going to tax. So the 200 has been excluded. 2,650,000 is what will be taxed. And when you find 30% of 2,650,000, your tax happens to be 795,000. So you see, this 795,000 naira tax did not include tax from 200,000 naira. So it means franked investment income has been excluded from the tax. Now that's how we do it. So the take home from here is list all your incomes from all sources. When it comes to investment income, list the gross. Dividend income, in this regard, if you are given gross, use it that way. If you are given net, divide by 0.9, you get your gross. Then you remove the investment income, which is the dividend income, so that you do not use it to, you do not allow it to suffer further tax. Then you tax. Now that's one take home. The second part of the question says compute the withholding tax due from the company. Now let's see it. Withholding tax payable on distribution of dividend. So now it means that when you are giving out this dividend of 700,000, you would have removed 10% from the money, which is now this 70,000 government. But you remember that out of it, 140,000 of this 700,000 was redistribution. So you need to less that. 10% of 140 gives you 14,000. So you remove that 14,000. You remove this 14,000. Wow, somebody is talking. Please, can we mute ourselves so that we do not disturb the class? All right, so now you have 770,000 naira as dividends supposed to be given to government. Now you know that 140,000 of the 700,000 is redistribution. So you look for the 10% of the redistributed one, which is 14,000. You exclude it. So it means that you are going to give the government 56,000 naira. Now, what it means also is you have only recouped 14,000 out of the 20,000 you suffered. This is because you redistributed 140 instead of 200. So if you have redistributed the whole 200, you would have recouped the whole 20,000. But since you've redistributed parts, that part you redistributed, you are going to recoup the withholding tax suffered for that part. I believe there is no question on this. If this is clear, can someone go to the chat room and say invest and dividend income is clear before we move on? If dividend income is clear, can you go to the chat room and say dividend income is clear so that we can move to the next one? Waiting for your responses. If it is not clear, go to the chat room and say it is not clear. And this is another way of making me know if you are actually hearing me. So if it's clear, go and say it's clear. Very good. Someone is hearing me. Akindele Olajimoke is hearing me. Who else heard me? We have about 5 students here. Who else here heard me? Only 1 student heard me. Well, I take it that the student spoke for everyone. Okay, Abiodun is giving some thumbs up, meaning that Abiodun heard me. That's fine. I take it that everyone heard me. Okay, Daniel is saying dividend income is clear. Very good. Now let's move to the next one, which is interest income. Now, what is interest income? The income from any interest on money lent by an individual or executor or a trustee outside Nigeria to a person in Nigeria, including a person who is resident or present in Nigeria, as at the time of the loan shall be deemed to be derived from Nigeria if there is a liability to payment in Nigeria of the interest, regardless of what form the payment takes. So this is telling you about interest income, especially those ones derived from outside Nigeria. Now, one thing I should tell you about interest income is, one, if you give out your money on loan and you are receiving interest, let's say from bank, you are receiving fixed, you put your money on fixed deposit and they're paying you interest, or you give your, you buy preference shares and the company is paying you interest. Now, this is different from when you buy ordinary shares and the company is paying you dividend. Now you are buying preference shares is like interest, or you buy debentures or government bond and you are being paid interest. All right, so let's go down to interest exempted from tax. The following interest incomes are exempted from tax. Interest accruing to a person on foreign currency domiciliary account. Another one of interest here is interest on loan charged on public revenue of the Federation and raised in United Kingdom. Another one is let me see, another one of interest. Interest, agricultural trade or business. So when you take a loan to do agricultural trade or business, this interest is exempt from tax. The fabrication of any local plants and machinery is exempt from tax. So now, like dividends, interest is deducted at source. Interest is deducted at source, and it's paid to you on net, except those ones that are exempt from tax, then you are not charged tax. You are not charged withholding tax on that. Now, it means that whenever you are given a question, if the question did not tell you interest, gross, dividend, gross, just assume they mean net, because the law has given us a clear guideline that always pay the net. In a question where it is silent as to whether it is gross or net, always think of it as net, not gross. Except it is stated as gross, then you take it as gross. So in the case of interest, you do not have something called frank investment income in interest. This is because why the dividend is regarded as frank investment income is because dividends is the last thing that the shareholders take after all deductions has been done, including taxes. So before you get dividend, the income in question has suffered tax. And so dividend is a residual. And so you see why it should not be subject to further tax. But in the case of interest, you have not suffered tax before. So there's something called earnings before interest, taxes, depreciation. And now you remove your interest. So interest is always being removed first before tax. So interest is like something called pre-tax interest. Dividend is always post-tax. Interest is always pre-tax. And so you see here, the only tax that interest would have suffered is withholding tax. So interest is not regarded as frank investment income. So if you are given income from all sources and you see unearned income, you see dividends, just make a notation, FII, frank investment income. Now, when you see interest, it's not included. But the only thing common with them is some of them are exempt from interest, some of them are exempt from tax. For interest and dividends, similar items are exempted from tax. But dividend is not subject to further tax, whereas interest is subject to further tax. Let's go now to rental income. Now, rental income is the income you receive, the gain or profit arising from other person using or occupying your property. So it means that you are a landlord. A landlord doesn't mean that it is a house. You could be a landlord of a plant and machinery, and somebody is renting it. That's rental income. Somebody could be renting your car. That's rental income. Somebody could be renting your apartment. Somebody could be renting your laptop or anything. As long as you are having rental income, that's rental income. But for the case of this class, we shall look at rent from property, like house. Now, rent received in advance. If rent is received in advance, it will be spread over the period of the rent, provided the rental period is not more than 5 years. So if it is received in advance for 3 years, to spend for 3 years. If it's received for 5 years, to spread out for 5 years. However, if rent received in advance cover a period that is more than 5 years, then the spread will be for 5 years. Thus, for tax purposes, the gain or profit arising from rent of a property is ascertained by deducting only those expenses that were directly incurred for the purpose of earning income. Now, for the sake of this, we're going to look at allowable expenses for rental income. Then we'll look at non-allowable expense. So the key word here is any expense that is done for the purpose of earning an income. So it means that anything enjoyed by the landlord is not used for earning an income, so it's not allowed. So let's look at the list now. In computing the gain or profit from rental income tax purposes, the following expenses are allowable deductions: tenement rates or land use charge. Now, tenement rate is applied only when you are renting the house. Land use charge is only for Lagos State origin and Lagos States. It is only applied when you are the landlord of the land. So either of them covers the same thing, they are allowable. Now, the cost of collecting rent, for example, you have a caretaker that you are paying so that he collects the rent for you. Lawyer, the account, and the lawyer is sending the rent to the landlord. So that fee paid to the lawyer is allowable because it was used to earn income. Now, cost of advertising for tenants. Okay, so you are trying to advertise for people to come to your house. You went to Facebook, you did Facebook ads, you went to LinkedIn, you went to Google ads, and you paid for adverts. Or you went to radio stations, or you went to newspaper. Anything you spend for adverts, for advertising for tenants, is for earning income, and it's allowable. Now, any expenses incurred for repairs and maintenance of the building, it's allowable. Note that should not be confused with extension of it or make capital expenditure. That's different from when you are putting projection, you are putting extension to the property. Now that's not repair anymore. You get to see that in disallowable expenses. Then we have bad debt incurred. Bad debt incurred could be your tenant did not pay. There are some people that you give them quick notice and they tell you, give me 1 year or 6 months, and they didn't pay those ones. So that's a bad debt incurred. You have to deduct it as allowable expense. Now, when you borrow money to renovate the property and there is interest on the money you borrowed, the interest you are paying is allowable. All right, then we have insurance premium paid on the property, and we have water rates. All right, so these are allowable expenses. Now let's look at the disallowable expenses. What are these disallowable expenses? Any expenses that are not incurred for the purposes of earning rental income. For example, you repair, when you are doing repairs and maintenance, you now repair the landlord's building, the landlord's room. That will not be for earning rental income because the landlord is not paying rent to himself. So that will not be allowable. Then any expenditure of a capital nature, I mentioned projection of a building, extension, drainage, and what have you. Once it is a capital expenditure, it is not allowable. Then we have depreciation of the building. Depreciation is not allowable. Then appropriation of profits, including income tax, drawings, reserves, and so on. Now let's see a question here. This is tagged Mr. JSMS. Let's see how Mr. JSMS fell. Mr. JSMS owns a property located at Glover Road, Lagos. Now he declared his net rental income for the year ended 31st December 1996 as follows. Now you see here, he brought his rent received gross. Well, that's good because you have to present it as gross. Now I note for something to note here, if your rent is given to you and they are silent as to whether it is net or gross, the law will take it as gross. The law will take it as gross. And so they want to charge you withholding tax on it. So unlike dividend and interest that they will take anything you receive, they'll take it as net. Because by law, you would have received net. Here, they take it that you have received gross. But one thing about Nigerian tax is that when you are putting, for example, you are preparing your income statement and you put rent as an expense, they will take it that, okay, this is the gross, but they will still charge you withholding tax. Yes. So you are going to be paying more. So it's good to show, okay, yeah. So it's good that whatever you are receiving, whatever you have paid to the landlord, whatever you've paid to the landlord, since you are the one that is still going to pay withholding tax, that thing you've paid to the landlord is net. Now, when you are reporting it in your book, report it as gross so that the law will take the 10%. So it means that if you've paid something, if you've paid, let's look for, okay, we'll talk about it later. So just note that the rent here is gross. Whether you've given a landlord net or gross, the same material, you've reported it here as gross. Deduct expenses, water rate and tenement rate, that's correct. This tenement rate is allowable. Water rate here is allowable, that's fine. Caretaker wages, allowable. Repairs, allowable. Electricity, allowable. But now, depreciation, not allowable. But still, JSMS went ahead to deduct it. And now, it now brings its net rent to be 71,530. And so this is what is declaring that this is his net, that is supposed to be charged tax on this. But on further examination, you are supplied with the following information. Capital allowances granted for 1997 assessment year amounts to 7,200. Now look at this. Capital allowances is used in place of depreciation. So depreciation has been used 15,000, which is more than the capital allowance that is supposed to be removed. So you see here, there's a problem. There's going to be an adjustment. Then included in electricity bills. So when you say included, it means something has been added to, something has formed part of electricity bill. We mentioned here that electricity bill of 32,140 is allowable. But now they are telling us something. Included in the electricity bill was 12,000 related to the lighting of the landlord's flat. Lighting of the landlord's flat will not produce revenue. So this 12,000 should have been excluded from 30,000, 32,140. What would have been used should have been 20,140. The 12,000 should be removed from the electricity bill. It was not, so we do something about it. Included in the repairs were the following: extension to the property. Now, extension to the property was included in repairs and they deduct it. It is not supposed to be so. Extension of the property is a capital nature. So also is new drainage. New drainage. But now you see here, painting of flats not occupied by the landlord. So this, the part not occupied by the landlord, fine, it's allowed. Assuming it is said painting of flats occupied by the landlord, then that would be not allowable. Then we have part of water rate bills of 2,400 was for the taxpayers flat. Who is the taxpayer? Mr. JSMS is the landlord. It's not for income purposes, and so that is not allowed. Now you are required to compute the amount of rental income on which the taxpayer should be assessed to tax for the assessment year 1997. Excuse me? All right, so let's go straight to the solution. All right, Mr. JSMS Solution. Now let's look at it now. Computation of rental income. We'll start with what we had first, what we had last in the account. We started with the rental income. So when we do that, all those things that has been deducted previously, but it's not allowable, we will not add them back. So the first thing to be added is, okay, the first thing to be added back is water rates. This water rate of 2,400, so we are going from down to up. This 2,400 has been deducted previously to get this net rate. So we are adding this 2,400 back because it's not allowed. Then the next thing is this 5,400 has been previously deducted. We are adding it back. This 720 has been previously deducted. We are adding it back. Then electricity bill 12,000 was previously deducted. We are adding it back. So all the information in the additional information has been used. The next thing now is for us to look at depreciation. Depreciation has been deducted. We still have to add it back. So that's what it is. We added it back. So when we add every other thing here, it gives us 35,770. This is means we've added back. When you add it to 71,530, our assessable rental income has grown to 107,300. Now, since we've added back depreciation, we should remove capital allowance. The question tells us that capital allowance 7,000. You do that, it gives you 100,100. And that's so far for rental income. So I want you to go to the chat room and state that both interest income and rental income is clear, understandable. I'll give us 1 minute for that. Let's go there and give our feedback. The fact that nobody is responding shows that I have not been heard. I'm sorry for the rest of the class. You may not see my face again because the lights I'm using is shining through my eyes as there's no light here. So forgive me if you see my materials, but not my face. I want us to comment if the interest income and rental income is clear to us before we move. Right, so Jumoke said, it's understandable. Once again, that's fine. We'll now go to royalty income. Royalty is a payment to an owner for the use of property, especially patents, copyrighted works, franchises, or natural resources. A royalty payment is made to the legal owner of a property, patent, copyright work, or franchise by those who wish to make use of it for the purpose of generating revenue or other such desirable activities. In most cases, royalties are designated to compensate the owner for the assets used and are legally binding. Now let's look at an example where we have musicians who sing, top musicians, they sing and people market and distribute their music and they are being paid royalties. Okay? Or you are an oil producing company and you are using the resources of a land. And so you pay the federal government royalty for use of the land. Or you're making use of my business name as a franchise and you are making money with it. That's a patented work or so. You are going to collect royalty for anyone who is using my work. All right. Now, royalties are often expressed as a percentage of the revenue obtained using the owner's property, but can be negotiated to meet the specific need of an arrangement. So what are they saying? Royalty is always expressed as a percentage, most times as a percentage. Now look at royalty exempted from tax. Royalty earned from abroad and brought into Nigeria. Royalty earned from abroad and brought into Nigeria shall be exempt from tax, provided that such income is brought into convertible currency and paid into a domiciliary account in a bank approved by the government. So see royalty when you are making use of copyrighted property, other people's knowledge, other people's talent, pay them royalty. Now let's look at an example here to illustrate all that we've done. Now, times when they will give you a question on royalty, they will give you mainly in percentage. Most times it's in percentage. But this example we are going to do now is example 3 to illustrate all that we've been talking about in investment income. Mr. Deboye is a top business executive. What does that mean? He's a top business executive, meaning he's in employment income. He's earning employment income. And they said, who is nearing his retirement age? Now, this retirement age shows you that he is in employment income. He has therefore decided to run a petty business, meaning that he is also earning business income. In addition to some investment in shares. In shares of some reputable companies. So that means it's earning 3 sets of income. It's earning employment income, business income, and investment income. The following information is given by Mr. Deboye. We say his monthly salary. We also saw the dividends and the business income for the period. Then we also see productivity bonus, and we are told that rent from property was for the period of January 1, 2011 to 31st December 2013. Then we are also given that this man has 6 children. All right. This rental income is for 3 years. And the question is we'll be asking you to find for 1 year. So there will be a need for us to divide this thing into 3 years. And remember, rent is taken as gross, and we take it as gross here. Then we are seeing here that Mr. Deboye has 6 children, all of whom are in secondary school. What's the relevance here? Is for something called the CRA, when we're doing taxation of personal income tax or payee, you'll get to understand. Then we have capital allowances relating to the business. Then we have Mr. Deboye has life insurance policy, and this is the amount assured, and this is the annual amount, 15,000. Then we have his statutory contribution. He has National Housing Fund and Pension Fund. These are the amounts he contributes to them respectively. Compute the income tax payable by Mr. Deboye for 2012 year of assessment. Now take note, 2012 year of assessment. Now this means that your basis period must be on preceding year basis, meaning that employment income, trading income and investment income will be on preceding year basis, whereas the employment income will be on actual year basis. All right, so let's see how we can solve this question. Right now, Mr. Deboye, that's the question here. Solution now. Since we are asked for 2012 year of assessment, you have to be careful. Now look at the employment income is only chargeable on actual year basis. And so because they put 2012 year of assessment, you have to use the actual 2012 salary and productivity bonus, which was given to us. Then business income. We know business income is preceding year. So we're going to use only 2011. All right, so after getting the salary and productivity bonus joined here, business income, we say is preceding year. We take the one of 2011, the productivity bonus too will also be, okay, sorry, the capital allowance for business income given to us should also be for 2011 because it must relate and match the profit given to us. So we have those two added, those two sorted out, and you have 5,040,000 and 40,000. That's your business income, the employment income. Then we have investment income. The investment income, since we are looking at 2012 year of assessment, it has to be on preceding year basis. It has to be only on 2011 assessment year. So if you look at the investment income there, this dividend of 2011 and even the revenue for 2011 are being used. It's already given to you as net. You're the one that will convert it to gross. All right, so we have here gross dividends. All these are already divided by 0.9 because we are giving net, converted them to gross. Now, rent is given to you as gross, but they gave you 3,600,000 and it's for 3 years. So divided by 3 to get 1 year, which is 1,200,000. So when you add 1,200,000 to 133,333 gives you 1,333,333. All right, so now we have gross income from all sources. That includes your payee, employment income, business income, and investment income. And that will give you 10,513,333. Now, this is what is supposed to be used for tax, but we're going to less franked investment income, which is the dividend. It's not subjected to further tax. So dividends alone is 133,333. We are going to deduct it, and we're left with 10,380,000. Now that's not all. Then we will now come back and look at what are the statutory deductions for an individual. We have the CRA. In the future topic, taxation of employment income, I will show you how to do CRA in more details. But just know here that CRA is going to be 20% of your gross revenue less, 1% of your gross revenue less, 1% of your gross revenue versus 200,000 flat. So it means you are comparing 200,000 flat and 1% of your gross revenue less investment income. So what are you going to do? We are going to look at whenever your gross revenue is less than 20 million, just always use 200,000 because it's going to be higher. But when your gross profit is more than 200,000, then you use the 2% because it's, more than 20 million, use the 20%, but it will always be more than 200,000. So suffice it to say here that 200,000 is higher. So we have used 200,000, then plus 20% of the gross income from all sources. Then when you do that, you remove the life assurance premium, National Housing Fund, and you get your statutory deduction and reliefs. You add them together and it gives you 2,842,667, which is what is being deducted to get your chargeable income of 7,537,000. Then if you look at it here, your tax computation, this is something you should have been aware of. Try and remember how your tax combination is sequentially arranged, and this will help you the exam condition, right? You need to now be looking for your tax guide. So if you know all these tables, this tax table in your mind, it's the same thing in the exam, just pour it out. So now when you calculate your tax up to the last one here, everything is 1,600,900. That's how you do your both income from all sources. CRA, somebody will say, what's the meaning of CRA? CRA means Consolidated Relief Allowance. Now, this is that the law says you should deduct it and don't tax CRA. So the law says part of your revenue and part of your income from all sources, let's exclude something called CRA and don't tax it. But the taxpayer is going to use that CRA for a number of things. Did you see in the question here that Mr. Deboye has aged parents and they don't have any income? Mr. Deboye is now catering for them. So whatever you're supposed to give to them is going to come out from this CRA. So your CRA is like government give you to spend it on those people who are depending on you, children, your dependents. Use it as their way of helping them. So I believe CRA is understood. And so aged parents is here. 6 children, all of them are in secondary school. All those ones, you are going to sustain them with the CRA. That's why it is being given and not taxed. All right, so we've seen question 3. Let's look at question 4. Mr. Chukwuokoye completed the construction of his building, built a 2-wing duplex located in Gwagwalada, Abuja on 31st December 2011. Now he rented out flats with effect from 1st January 2012 through an estate agent and received rent for 2 years. All right, you can see the details of the rent, received gross, and all the expenses he made. We are told additional information. Capital allowances agreed with the relevant tax authority for 2011 and 2012 were these. Then repairs and maintenance comprised, now look at it, depreciation, which is not allowable, that will be added back. Repairs of tenant's bathroom. Repairs of tenant bathroom is okay, so it's not allowed, it's not disallowed. Then we have repairs of Mr. Chukwuemeka's residence. Now that's not allowed because Mr. Chukwuemeka is a landlord, and repairs on a landlord's residence is not allowed for tax purposes. Then tenement rate includes rates of 5,000 and 12,000 paid on the private residence of Mr. Chukwuemeka, so that's not allowed. We are now told to compute the amount of rental income accessible to tax. Now, if you look at the solution, it's almost similar to what we did before, where we bring our rent received, repairs and maintenance. There's an allowable expense. So now, if you look at the first method we did before, we use something called the net method, where we started from the net profit. Here, we cannot start from net because we are not given the net easily. So we're going to start from the gross. And when we start from the gross, we are going to deduct allowable expense. When you start from the net, you are adding back disallowable expense because it has been previously deducted to get your net. But when starting from gross, when starting from gross and not from net, you are doing the right thing. You are going to you are going to allow or deduct allowable expenses. Take note of those ones that are allowable and those ones that are not allowable. If you do the right thing, the chargeable rent is going to give you these figures. For the sake of time and for the sake of the fact that my system is fast draining out, let's just quickly look at example 5. Nelson Limited is a company owned by the members of the Nelson family. It's issued share capital of 20 million naira, 20 million ordinary shares rather of 1 naira each, which is still 20 million naira. Is held by, these are the members of the family that holds the shares. For the year ended 31st December 2012, we made a profit before tax of 653 million and 01 year. Okay, for the year ended December 2012, the company made a net profit before tax 53 million. Now this is the profit before tax. the company made. Now, the company has not paid dividends since it was established 8 years ago. Now, the federal government is of the opinion that the non-payment of dividends by the view to reducing the tax by its shareholder. And so in exercising its power conferred upon it, the FRS has directed that the 15,900 of the profit be treated as distributed, has been distributed as dividend. So it means that look at this 53 million you got here. We are telling you that 15 million 900 is to be treated as being distributed as dividend. And when they are distributed as dividend, they have to pay tax on it. Compute the amount deemed to be the income in the hands of company's shareholders. Now, the company shareholders, they are deemed that they have received 15,900,000 in proportion of their shares. So Mr. Williams is having how much? 8 million is his shares divided by 20 million shares multiplied by how much they are owing, 15,900,000, to give you 6,360,000. Do the same thing for Samuel, but the only thing here is Samuel owns 4,000 shares. So you are going to use 4,000 divided by the total shares, 20 million, multiplied by 15,900,000. And when you do it all the way down to Nelson, you find out that each of them pay different amounts, all amounting to 18 and 15,900,000. So that's how this dividend is being shared. So all of these are deemed to be in the hands of the shareholders. So for the purpose of this class, we've come to the end of the class, seeing taxation of investment income, which is unearned income, seeing the basis period, we've seen those that are exempt from tax, and we've seen allowable and disallowable expenses. So please, if you have any question, ask in the WhatsApp forum. Okay? Because any moment from now, this class is going to end. But I want to thank you so much for taking the time to come to today's class and understanding the concept. We just pray that the exam, okay, someone says the second example that included all sources is not clear. This is the second example. Okay, second example from let me check where the, okay. The questions and answers, these are in the WhatsApp forum already. They are already in the WhatsApp forum. So no need to fear, they are already in WhatsApp forum. I'm trying to look at the question you are asking that has all sources that is not clear. Okay, here. All right. This segment here is employment income. We have the salary. Salary, you're still having comments. Okay. Mr. Deboye's question. Okay. Salary, we are using actual year basis. Since it is 2012, we are using 2012 salary. because salary is chargeable. Employment income is chargeable on actual year basis. That's why you're using it. We are still going to learn about employment income. So salary is 2012 figures we are using. Productivity bonus is also from employment, 2012 figures. Now, business income is preceding year basis, not actual year basis. So we're going to look at business income of 2011. Then immediately we'll less the capital allowance because it's for business. And that's why we got our business profits. Investment income is also preceding year basis. And we have our dividends gross. We're using 2011 dividends. So if you look at the dividend, look at all the dates for the dividend, 2011, divide them by 0.9. So this goes from 30,000 to 33 and all that. When you add all these dividends, you have 133,333. Rental income is investment income. And we're going to use only 2011, but we are given 3 years rental income. So divide it into three. Divide it into 3 and take 1 year. It's already given to you in gross. So take it as gross. And when you add your investment income, you have this. So your employment income plus your business income plus your investment income is income from all sources. Then you start the next one line here by removing the frank investment income, which is dividend income that was included in all sources. Now you are excluding it from tax. Then you have your gross income. Then you start doing all your reliefs and allowances. Don't worry, the next topic, which may be employment income, we are going to handle how to understand all of this. So once again, thank you so much for coming to class. We'd like to end the class now before my system stop and goes off. Thank you so much. And my hosts, can you do the needful? Because we've come to the end of the class.